Hi everyone, my name is Matt Argersinger. I'm an analyst at the Motley Fool. As part of our Ask a Fool series, Jan recently asked, how can I understand the effect of maximum sales charges and expense ratios when determining which mutual fund is best? Well, Jan, that's a great question. I mean, mutual funds expenses vary widely, and you want to be able to know them before you start comparing or determining which mutual fund you want to buy. The best place to do that is to go to the mutual funds family's website. Normally, they'll provide you a breakdown of all the costs of the fund, plus a before and after expense return. And of course, it's the after expense return that you really want to pay attention to, because that's ultimately the return you're going to get as an investor in that mutual fund. And you really do want to pay attention because a lot of mutual funds even come with front load charges in addition to those annual expense ratios. And so it can be very expensive. Normally you'll invest in a fund and that automatically a fund will take out about 5%. So it can be very costly. In fact, the average mutual fund, average actively managed mutual fund, can take about 20% of your initial cost basis in fees over the first 10 years you own the fund. So if you for example, invest $10,000 in a mutual fund, over 10 years, you're likely going to pay about $2,000 in expenses. So definitely factor that in to your expectations and the returns you expect to get from the mutual fund. Again, go to the fund's website or use services like Morningstar. They can provide also good information about mutual funds and the expense breakdowns. Thanks for the question, Jan. If anyone else out there has a question, please come to Fool.com or send us an email at askafool@fool.com, and we'll do our best to get your questions answered. Fool on.